Hey everyone, this is Jack. This is going to be a quick video about how to practice reading the market bar by bar like Al Brooks. I recently got a question. Somebody was asking how I practice or how they can practice getting better at reading the market bar by bar like Al or Brad or um, myself. And I thought it would be helpful to just make a quick kind of tutorial. It's fairly straightforward, but there's a lot that goes into it. So I've got a slide right here um, that we can go over, and I'll also share a link to a public video on the Brooks Trading Course YouTube channel where you can listen to Al do a bar by bar review the way that a lot of us are also practicing it at the end of the day, where he hides the rest of the chart and just goes one bar at a time and kind of talks everything through. And it's really helpful to listen to Al do that because there's a very particular way that Al does it that I think is super helpful for. It was super helpful for me to kind of realize, like, oh, okay, he's really recalling everything in his repertoire on each bar, and it's really inspiring in a lot of ways. But it's there's a lot that goes into it. So first of all, I think that there are some educational requirements. I think you have to go through the entire course. You have to read his books, and I think you should also be quizzing yourself about all of the price action information that you're learning to really know that you've learned it. Because it's very easy to just watch a video passively or to read a chapter and highlight things in a book, but that doesn't actually mean that you're actually learning it. And the best way to learn anything is called active recall. And that's basically just creating a quiz where you have to actively recall in your mind the answer to the question. So I think building quizzes based on the information you learn is the best way to learn. And with all of that, you should have a very good understanding of day structures, all of the patterns, all the different types of trends, all the different types of trading ranges, how to trade all of that, and risk, reward, and probabilities. All of that is super important to understand. And, there's a lot of little pieces, but they're all fairly simple and straightforward. It's just a matter of learning all of them, and then they kind of piece together as time goes on and you practice. So I'll give an example of Al reading bar by bar here in a minute, but I'll talk a little bit more. Some of the things that were helpful for me were collecting charts and building an archive to study and naming all of the patterns in that chart, and practicing that with, frankly, thousands of charts. I've done that with over 2,000 or 3,000 charts, and I've had to rebuild my archive once or twice. So I finally got my archive the way I want it now, and I'm pretty close to 1,000 charts in this archive, but I want to keep building it, and I want to see how big I can make it actually. And I think that's one of the best ways to just practice implementing the knowledge of the patterns, the day structures, and all of that kind of thing. And then aside from that, I think it's really helpful for me to watch the live market during the day and kind of think about the bars unfolding, the patterns unfolding, and then at the end of the day, do a bar by bar review, having already known what the day did, and kind of have that in the back of your mind. But just go one bar at a time, and then read the chart how it was supposed to be read, so you can read it correctly, and integrate that correct read into your practice, because we can all guess what's going to happen on the next bar or two. And I think it's helpful to do that like totally blind with no knowledge of what's coming, because that's what we're faced with every day. That's a very good practice. But I think it's also worthwhile to have a rough idea what the day did and then go bar by bar, because you can see places where something looks really good, but it failed. And there's a very good reason why it failed. And if you can train your mind to view the chart from the perspective of that reason why it's failed, then when you're doing it blind during the day or totally blind, you can see something and say, you know what, this looks really good, but there's a potential that this is a trap or it's going to fail because of this. And I think that's one of the benefits of watching the market and then doing a bar by bar review at the end of the day, having already known what happens. But yeah, also do bar by bars on random days with totally blind, not knowing what's going to come for study. And that's like the real test, because that's what we do when we're trading the market live in person. And then I also think, yeah, doing chart markups every day is super helpful. And when you're building a chart archive, you don't have to do like a huge session where it's like several hours all at once. You can just collect a few charts a day, make sure you like the methodology that you're using and tweak it. So it doesn't have to be a huge project, long lasting, for hours a day. You can just do, 10, 20, 30 charts a day or something like that. And over time, you'll be like, wow, I've got a few hundred charts and, that's pretty awesome. I want to make it bigger. So anyway, I think so for now, I want to pause. And before I go over the rest of what I wrote on this slide, let's just listen to a few minutes of Al going bar by bar on one of the videos on the Brooks Trading Course YouTube channel. So 1 second and I'll pull that up. And just so you know, I've got a link to this video in the description as well, so you can watch the full video once we get finished up here.
On the open today, we had a bull bar closing near its high. When you have a buy climax day like Friday, there are a couple things that you should know. First is there's a 50% chance that you're going to get some follow through buying on the open, and bar one is consistent with that. But there's a 75% chance that by the end of the second hour, the market will go sideways to down for at least a couple of hours. So that is what's likely. So here we have a bull bar closing near its high, but we know whatever rally we get will last 5 or 10 bars, probably not much more than that. So you have to be prepared to get out fairly quickly if it starts to reverse, because we might get a leg all the way down here. This was an area of agreement on Friday, and if this does not go up too far, this would be within reach.
So already right there, you can hear Al talking about what happened yesterday in relation to what's happening with the first bar of the day, and what that's setting up for today, and what's likely to unfold over the next few bars, and what he would kind of do. So there's a lot of active, observation, reflection, and there's a lot of detail just with that short little bit there. So just wanted to mention that. I mean, I think it's helpful on the open of the day to always review yesterday and then talk about how the opening range today could possibly relate to what happened yesterday. Just wanted to mention that.
Market bulls bought the moving average here and here and here and here and here, and they're buying just above the moving average here. Possible low of the day, but I think we're going to end up having at least a couple hours of sideways trading at some point, again, starting before the end of the second hour. If you buy above bar one, it's reasonable. Stop below one, I would trade small and add on as it goes up. For example, you buy above two. Now, that's a surprisingly strong pair of bars early in the day. It's always in long. It's strong enough to buy the close. Traders will buy the close, they'll buy at the market, and they'll buy above it. We went a little bit above it, and then we had a bear bar closing near its low. And if you're long, for any reason, buying above one, buying above two, and it goes below three, I would get out, because then we have a buy climax from yesterday and a wedge, 1, 2, 3, and a good sell signal bar. And this could be a bull trap on the open in the start of a trend down from the high of the day. And so reasonable to exit below three. And three is a disappointing bar. So some of the bulls who bought the close of two will try to get out break even if it gets back to the close of two area. And it did. Bar.
And I think something important to mention there is he's acknowledging both sides of the market. There's a very clear bull case. You could look at this with the perspective of the bulls in mind only, and you can look at this with the perspective of the bears. and disappointed bulls and disappointed bears. All of that influences what should come next. So just wanted to mention that.
4, we went 4 went far above the close of 2. So instead of bulls getting out, bulls bought more. And that's good. It increases the chances that we'll go higher. This might be a gap. It might lead to a measured move up.
It increases the chances we go higher because there's strength. There's disappointing follow through with bar 3, but bars 1, 2, and 4 are strong enough that increases the probabilities that we go higher. So what kind of day are we likely to have? We're probably forming a trend from the open. He mentioned earlier, it's very likely that we'll have a couple of hours of sideways to down. That means it could be a trending trading range day. So far, we have trending behavior. You're basically trying to bring forth all of the knowledge that you've learned and apply it to the chart that we're looking at right now. He also mentioned, you could buy the close of 1, you could buy the close of 2. There's a risk associated with that. The risk is a wedge top. We could trade back down into the tight trading range from the middle of the day yesterday, but we're always in long. We're above the moving average, right? Like these are all just very clear, very honest observations, and there's no emotion involved. It's just facts, So
it's still buy the close. Traders are still buying at the market. And then bar 5, it's a problem. It's a bear bar closing near its low, and it's a good sized bear bar. It's reasonable to get out below 5. You can always buy again if you get a bull bar in the next few bars. So reasonable to get out of longs. It's 5 bars without a pullback. You can argue wedge, but 5 bars without a pullback. Probably if this is a minor reversal, and there probably will be buyers not too far below 5. So I would wait for a second sell signal and not go short below 5. 6, for the bulls, it's a high 1. It's a very strong bull trend, a small pullback bull trend, but it's a bear bar and it's consecutive bear bars. So that is not a very good high 1. Bar 3 is not a very good high 1. It was a sideways pause in the bull trend, but it's still a buy signal above 3. They bought above 3, they bought above 6. When you get bad buy signal bars in a bull trend, it reduces the chances that the bull trend will last all day. It increases the chances that you'll get a reversal, at least into a trading range. And that's consistent with what we already know. The day after a buy climax day has a 75% chance of having at least a couple hours of sideways to down trade.
So right there also, he's slowly building a thesis about what's going to happen throughout the day and possibly throughout the opening range. He's mentioned that we're always in long. There's a reasonable buy. It's a little disappointing, but the bears don't have much going for them because the bulls are appearing stronger than the bears, at least for the time being. But he's well aware that based on his studying, Al has built extensive chart archives. He knows that there's a very good probability of sideways to down for a couple of hours after a buy climax day, which is what we're looking at here. And he also knows that when you get bad signal bars for stop entries in a tight bull channel, bar 3 is a bear bar. That's not a strong buy signal bar, but bar 4 went far above bar 3. That's a high 1. That's a bad signal bar. And now we have another bad high 1 with 6. And, he's going to say if we go above that bar, that's another bad buy signal bar. That's going to reduce the probability that this bull trend is going to be sustainable for a long time, because in bull trends, the buy signal bars typically aren't strong bear reversal bars like 3 closing on its low, or consecutive bear bars like 5 and 6. So this evidence that we're looking at is then strengthening his original thesis about just a basic statistic that he got from building his chart archives over the years.
Okay. So we're still in a small pullback bull trend, but not good buy signal bars. That increases the chances that we'll get a reversal before too long. As I said, maybe 5 bars, 10 bars, maybe a little bit more. And now we have another high 1. 8 is a pullback in a small pullback bull trend. No sign of a top yet, but it's a bear bar. So we have a bad buy signal bar 3, 6, and now 8. It's still a small pullback bull trend, so traders will buy for any reason. They'll either buy above a high one, a bad buy signal bar, or they'll buy at a new high. So they'll buy with the stop above that. If they don't want to buy above a bear bar here, they'll buy with the stop above that. And so far, the bears are not making money. Limit order bears, if they sold at the 5 high, it had to fall 22 ticks for them to make money, and it did. Each line is 5 points. It fell a little bit more than 5 points. So now limit order bears are starting to make money. And that increases the chances that the market is transitioning from a strong bull trend into either a weaker bull trend or a trading range, and less likely into a bear trend.
So right there, more evidence that we're probably soon going to evolve into some sort of trending trading range day where there's a swing down for the bears. That's what Al was talking about earlier. And now he's saying, okay, bears haven't made money all day up until selling the high of bar 5, which would have been filled on bar 7. And then the following bar 8, fell far enough for those bears to make 5 points. And for Al, he kind of averages the bar ranges and estimates what an average scalp distance would be, and he considers that making money for one side of the market or the other. So far, bulls are making more money than bears, and so far the bears really only have maybe one or two, maybe two scalps, but now limit order bears selling above things are starting to make money. So that increases the odds that we transition into a trading range. Basically, what is happening on the chart? What is the honest, pure observation of what's happening on the chart? And what does that do to the probabilities for the bull case and the bear case?
Another bull bar closing near its high. So if traders get out for any reason, they buy again above 8, 11. 3 consecutive bull bars, all closing near their highs. So the first reversal down will probably be minor. I would not short below 12, but if the stop order bears start making money, if the market falls far enough below the low of a bar for bears to make money, scalp, then I would get out. So if it falls 22 ticks below 12, stop order bears could make 20 ticks, 5 points, I would get out. And it's a high one. But as I said, we're probably not going to go up much further. So if you buy, I would be really, really quick to get out, because as I said, we should be soon having a leg down, or at least sideways, lasting at least a couple hours. And this is extremely overbought. Bar 13, an outside down bar, but a small pullback bull trend and a tight bull channel. So I would not short below 13, but if I'm long, I would get out, similar to getting out below 5. You can always buy again if 14 or 15 is a bull bar. Instead, 14 was a surprisingly big bear bar.
And you can see also on bars 11 and 13, we have a micro double top. We went up on 11, down on 12. We made a new high on 13 and then turned down. That's a micro double top. And though the signal bars for the short aren't very good, it is reasonable given the context and also given the probabilities that are expected to unfold today. Now we have evidence of the trending trading range day or possible opening reversal down with bar 14.
And it's a bear surprise and a buy climax. Different ways to look at this as a wedge: 1, 2, 3, 4, 1, 2, 3, or 1, 2, and then 3 subdividing into 1, 2, 3. In any case, we know we're going to have a couple hours of sideways to down trading, 75% certain. And this is a really good looking bear bar. So it's probably the start of a sideways to down move. It could be simply sideways, but we'll probably get at least 2 legs down after a bear surprise and a buy climax. So traders will sell the market, sell out of long, sell into shorts, or sell below 14. 13, 14, we have consecutive bear bars, one being big and closing near its low. So it's sell to close. It's still probably a minor reversal, but it's sell to close. I would not buy at this point. Another bear bar, 15. Now we have 3 consecutive bear bars, one of them big and closing on its low. We should get a couple legs sideways to down. So better to be short or flat And if you're short, you can get out above 13. And now we have another bear bar, 16, closing near its low.
So he's also talking through trade logic. As the patterns unfold, there's a good time to be long, good time to be short. There's also a good time to be flat. And sometimes you see something that makes sense, but it just doesn't sit well with your risk tolerance. So you could say, it's reasonable to be short here. Okay to be flat or short. Not a good idea to be long. Better to be flat or short. Right? There's always three different positions that we can have at any time in the market.
So right now it's a sell to close market. We have a close below the moving average. We closed the gap between the 6 low and the 3 high. So more and more bulls are giving up. We have a small spike pullback channel, and we're closing below the bottom of the channel. So it's probably going lower. So you sell the market or sell the market as soon as 16 closes, or you sell with the stop below 16.
So he mentioned the spike in channel with the low of bar 6 being the start of the channel. And that's important because the low of a channel is typically the low of a trading range. And if bar 15 is breaking out strongly below the low of a trading range, that means it's resetting the market cycle, and that means it's a spike. And it's typical for a channel to follow a spike. So you'd expect continuation down. And so we're acknowledging the real-time price structure that's unfolding before us that started on bar 13, and we're relating it to the day structure that's unfolding from bars 1 to 16 so far. And we're also tying that in together with yesterday, understanding the day structure of yesterday and the probability of what typically follows that sort of day structure. So you have to constantly be looking to the left, is what Al would say. But what I would say is you have to constantly be thinking about the current day structure, the current price structure. You could say that the first price structure of the day was bars 1 and 2, then we got a pullback, and then that price structure grew all the way up to 12, and that price structure became complete. You could say it's a parabolic wedge top. It's also a wedge with yesterday's bull channel. And there's many smaller price structures in the bigger price structure, but now we have a new price structure that's taking place from 13 down to 16, and that would be, a bear spike essentially. But we're not below the low of the day yet, so we're still technically in a trading range. But so far we have a spike, and it looks like we'll probably get a new low of the day. And we'll just watch a little bit more, and then I'll wrap it up.
17, it's another very good bar for the bears, so same thing. Sell the close, sell the market, sell for any reason. Now, every day has a 90% chance of having at least one swing that goes 40% of an average day's range, and it comes from a good signal bar. On the way up, we have a good buy signal bar here. So is this going to be the start of a move up? Well, this high is 76 ticks above that. And if the average day's range is 50 points, 40% of that is 20 points, which is 80 ticks, and it will have to go 82 ticks above 1 for the bulls to make 20 points profit. And this is 76 ticks above. So the bulls have bought above 1, hoping that this would be a swing trade. They gave up on 14. 14 is a really good bear bar and a good candidate for the start of a swing down. So it's reasonable to sell below 14 on a stop and try to get out 80 ticks below your entry price. So you enter 1 tick below 14. You need 80 ticks to make your 20 points. And if you're exiting with a limit order, 80 ticks below your entry, it has to go 1 more tick. So you enter 1 tick below 14. It has to fall 81 ticks more for you to exit with 20 points. So it has to fall 82 ticks below 14. So a lot of bulls will place limit orders to get out. A lot of bears will place limit orders to get out at 82 ticks below 12. And right now it's sell to close and looking good. It's still sell the market, sell to close. If you traded small, you could add on here and add on here and add on here. We may get some bounce around the earlier low of the day. The bulls are hoping that we get a double bottom in a rally. but this is so strong. It's a major bear surprise at this point. A bear surprise increases the chances that you get at least a small second leg sideways to down. A major bear surprise increases the chances that the day will either be a trading range day or a bear trend day. So this could be a spike, and then we could bounce and get a channel down, or it could be a sell climax, and we could rally back up to the high and then just go sideways all day. A doji bar in a sell climax. That is a neutral bar. The bulls equal the bears, are pretty close to being equal. So it's probably getting close to the end of the selling. And as I said, there'll be bulls buying back, there'll be bears buying back shorts, 82 ticks below 14. The bulls know that, so bulls will start scaling into longs, betting that we'll get a bounce pretty soon, maybe a bounce to 50% of the way up. Another sell the close bar, but a tail, and it's after that doji bar, and we're getting pretty close to 82 ticks below 14. So I think it's probably better not to sell the close, even though arguably you could sell the close. I would wait.
So just a minute ago, just a couple of bars ago, bar 18, Al said, sell the close, and it's still looking good. And all of a sudden, bar 19, his attitude totally changed. And he said, all right, the selling's probably going to end soon. And that's because the context has changed. We have smaller bodies, smaller bars up to 18, and now 19 is a trading range bar and a doji, and there's a lot of overlap. And we're right around the open of the day. So that means we could bounce, and this could be a sell climax. And he also mentioned that there are two possible day structures that we're looking at right now. We're possibly looking at a trading range day where we bounce somewhere around the open of the day and then we go mostly sideways, or we're looking at a strong spike that will lead to a pullback and a channel down for some sort of bear trend day, or possibly a trending trading range bear trend day. So anyways, I hope that was helpful, and let me wrap it up and get back to the slide. So anyways, one other thing I want to mention is that Al is trying to anticipate what possible pattern is going to take place within the next bar or two. So whenever the market is approaching an area of resistance, he's always acknowledging like, okay, we have a bull bar, but we're right at resistance. So that means we could be looking at the top of a double top. And I think it's important to get into that sort of habit, because all reversals take place at resistance or support. And if you have the idea that could happen, you can start to anticipate what that would look like. And then when you start to see that unfold on the chart, that kind of validates a thesis, and now you have a trading plan. Now you can say, okay, we're getting a double top, we have a micro double top, and now we have a strong sell signal bar, increases the odds that we go sideways to down. So anyway, yeah, when I'm doing bar by bar reviews, just wanted to say that I try to think about yesterday a little bit. I think about the opening gap. What does that mean for the coming day? And I look at the daily chart for higher time frame context. What are we doing? Are we in a trend or trading range? How did yesterday respond to the day prior? What does the weekly chart look like? And what could today possibly do in response to yesterday? And how big is the gap? What does that mean? But doing all of that is just to kind of review and prepare yourself for like, okay, this is like a range of possibilities. This is my imagination about what could take place. It's important not to get too attached to that, because it's also important to focus on the immediate structures. And that's, for me, I remember to do that by remembering, I came up with this kind of little clever saying, and I call it the 2+2 perspective, because there's a bull perspective and a bear perspective, and that's taking place on every single bar of the day. So it's always important. Every single bar, for the bulls, this means that. For the bears, it means that. So that's the first two perspectives. And then there's another two very important perspectives, and that's the day structure. Al was just talking about how we're in a small pullback bull trend, but it's very likely that we're going to trade sideways to down. So the day might actually end up being a trading range day or actually a bear trend day, even though we're in a small pullback bull trend right now. So it's very important to understand what is the day most likely to do based on yesterday, the gap, and what's happening right now. So that's the first part of the perspective. And then the second part is the immediate price action, the immediate price structure. Despite the fact that there's a high probability we'll trade sideways to down, and that could lead to a trading range day or even a bear trend, immediately what's happening right now is called a small pullback bull trend. We're always in long. So that doesn't mean I should just sell at the market because I'm looking for a trading range or a bear trend day. That you shouldn't do that at all. You should trade what you have right in front of you. You have to look at the evidence of what you have right in front of you, despite the probabilities of what's supposed to happen that day. That first of all, that doesn't have to happen. Don't get too attached to it, but it could also happen later or earlier than you might expect. So you have to consider all of these perspectives holistically. And that's why I call it the 2+2. Because bull and bear, that's always together. Those two perspectives belong together. But I also think you can't just think about the day structure in and of itself in a vacuum. You have to also consider the immediate price action. What's happening right now? Even though I'm looking for a possible bear trend day, right now we're in a small pullback bull trend, always in long. I'm not going to sell until I see a credible top, and then good follow through, etc. He's also noting the characteristics of signal bars and context. Well, that's what I'm doing. I think Al is doing that too. For example, when we had the sell-off that was getting close to the open of the day, he said it's sell to close and it's looking really good. And then that changed with one bar. And that one bar was a trading range bar, and it had a lot of overlap. And because of that one bar, he thought, okay, 1 bar ago, it was sell to close, and we're probably going to go lower. This looks really good for the bears. But all of a sudden, this trading range bar completely changes everything. Now I'm thinking we're probably going to bounce. We're probably going to get a pullback, and we may not get a bear trend at all. We might just get a trading range instead. So the context ties into it as well. The context is always more important than the signal bars. So don't get caught up looking at the signal bars. If anything, you should be caught up thinking about the context, the 2+2 perspective, the bull perspective, the bear perspective, the day structure, and the immediate price action. But yeah, look for possible patterns that are forming as of this current bar and what could possibly take place on the next bar. And just imagine if it was a big bull bar. What would that do to what's happening right now? What would that do to the day structure? What does that mean for the bear case? What does that mean for the bull case? And then the opposite. Well, what if we get a bear bar on the next bar? What does that do for the bulls or the bears? What does that do for the day structure? What does that do for the immediate price action? And then periodically, it's good to just check in and state the day structure that you have right now. At the end of that clip, Al was saying that we could have a trading range day. I think it's just important to kind of check in with yourself because the day unfolds through time and it can change structure through time. Sometimes it changes structure early in the morning or the middle of the day, or sometimes around the end of the day. And it's important to kind of anticipate what could happen in the rest of the day and typical behavior of that day structure. So I think periodically it's good to remember, okay, what is the day structure that we actually have right now? But yeah, last thing to mention is just that you're basically bringing forth all of your knowledge. And if you don't have that much knowledge or you're not very confident with the knowledge that you have, you got to go back to your educational requirements. You got to study the course, study the books, and make quizzes for yourself. You got to learn all this stuff. Probabilities, traps, always in, trends, trading ranges. There's so much more than what I've just listed there. But anyway, hopefully that helps. And please like and subscribe, comment, let me know if this was helpful. And I appreciate you watching. I'll see you next time. Thanks. Bye.